Hey guys, this is Lane Kawaoka here with Chase Keller, and we're going to talk about the Ankeny Pine apartment investment. This is an investment, 52 unit multifamily Class C, purchase price little over $3 million that we're going to kind of go over in the next hour or so. But just want to kind of put out the confidentiality clause, and you guys can take a look at this later. But all these documents will be sent out via PDF. So we're going to be kind of going through all these slides pretty quickly. But you guys can review the slides at a later date. We're going to talk about the management, and we're going to introduce ourselves, the team. Me and Chase are going to be the co-leads on this. The executive summary, and then we're going to go over the property and the business plan, and then kind of go through talk about the market here in Des Moines. And first, I wanted to introduce myself for those of you who don't know who I am. My name is Lane Kawaoka. My professional resume is I'm an industrial engineer to start. I got started working about 10 years ago as a civil engineer with emphasis in construction management from the University of Washington. Began working my career as a construction manager, and that's me on the left. I was a roadmaster working for the railroad. Didn't really like that job, but that's why I'm doing real estate today. I kind of transitioned to more of a project engineer role, in charge of design, permitting, construction. I think I'm more about 200 million at this point of total constructed projects. 2015, I was a city engineer, and currently today I'm an airfield engineer in the state of Hawaii. My real estate background, I grew up in Hawaii and I moved to Seattle in 2003. And in 2009, I began investing in an A-class rental that was $350,000 and rented for $2,200 a month. And at that point, I was an accidental landlord, and that kind of snowballed from there. From 2012, I traded my Seattle rentals for 11 single-family homes in Birmingham, Atlanta, and Indianapolis, and one in Newcastle, Pennsylvania. Became an international farmland investor with some coffee parcels. And that year in 2016, I spent a lot of money investing in my own education, joining different masterminds and different groups. I joined an apartment mentoring group, syndication group. That's where I met Chase. And about that same time, the peer group that I was having and kind of where I was in my investing career, I just realized that single family homes just was not scalable and wasn't going to get me to my goals. So that's kind of why I went into multifamily about a couple of years ago. Since then, I started the simplepassivecashflow.com Hui Deal Pipeline Club. Started partnering with my investors, and we acquired $50 million worth of real estate in 2016 and 17. Raised over $4 million within the group, and I'm co-owner of MFP Investments, where we own 626 apartment units and 199 RV units. So a combined total of 825 through 5 apartment buildings in San Antonio, Houston, Oklahoma City, and I'm hoping to work with Chase here to bring a few more in Iowa. Chase, why don't you introduce yourself?
Hello, everyone. I'm Chase Keller with Keller Investment Group. I grew up with my dad always owning a few rental properties, so I grew up helping him with the management, helping him with the maintenance. I got started. My dad sort of forced me into real estate, helping me buy my first property. He saved up all of my paper route money growing up, and told me when I was 16 that I was either, well, he really didn't give me an option, forced me to buy my first rental property, bought that, fixed it up, sold it, bought another one, did it the same thing before getting out of high school. Flipped a few properties before getting into college. Also worked some construction jobs. And we can keep moving through this. Been on a lot of different sections on the real estate route. I was a realtor for a while. I eventually went to college, completely different field, moved to New York, lived there for a while before coming back home and getting back into a real estate. My real estate background from there is about shortly couple months after I moved back to Iowa, bought 10 units in one group, started fixing them up. And I started very much on the mom and pop side. I was the one finding the deals. I was the one getting them under contract, purchasing them, doing all of the renovation, doing all of the maintenance, all of the management, and did that for several years, just building my portfolio, throwing all of my money back in to keep growing. Eventually, like Lane said, the single family, small multifamily isn't incredibly scalable. So a couple of years ago, I made the decision to jump into the larger multifamily side, and that's where I'm at now. Since 2011, I was able to quit my job, be a real estate investor full time, and I've loved it ever since.
And you never look back.
That's right. I also do, I'm owner of Iowa Cash Flow. We do a bunch of wholesaling, which has been fantastic to be able to find a lot of great off market deals, not relying just on what's on the market and relying on realtors to be able to find the right properties to get into. Joined the Real Estate Guys Syndication Mentoring Club. Like Lane said, he joined a few mentoring groups, joining a few groups nationally to help build our network, build our knowledge on what to do and how to the best to do it. And then I also started I Think Real Estate. It's a local group here in the area, investment club, just focused on education, helping people through their real estate journeys.
Yeah, so Chase and I have, pretty good complementary skill sets, I think. Chase is more the boots on the ground. He's got a lot of the operational experience, and I don't know. I don't know really what I'm doing here, Chase. I'm just trying to help you out, doing what I can. But when this opportunity came up, usually a lot of these projects are a lot larger, and this is a pretty good opportunity to both of us to learn different skill sets from each other. I'm pretty excited about working with you, Chase.
Me
And
too.
but this isn't the first time trying to work with each other. I think we met probably in early 2016,
Yeah.
and we kind of got entangled in the Stonebridge apartment. If you want to tell the story on this one.
Yeah, so pretty interesting. This was a group of, it was 238 units in a smaller town here in Iowa, a market that I know fairly well, but it was a little outside my box. This was an old military hospital that was converted back in the 80s into apartments, and it's been managed horribly for the last few owners. Only, I think, 50 out of the 200 and some units were even rentable. Needed a lot of renovation. I jumped in. Um, there's a tremendous opportunity there. I put some money down. Eventually, it went hard, and as we were really getting into some of the contractors, some of the renovation budgets, it was just getting up way too high for me to feel comfortable asking investors to join me. So eventually, we decided to back out. I lost some money, but overall, I have to. My desire is to give good products to our investors, not just force any deal to happen. This is not the only deal that I've been into that didn't work out. Some of the best deals are the ones you don't do, and this was one of the deals that we did not get into.
All right, and this is just want to kind of put this in here because a lot of guys, when I put this out initially, were, oh, is this the same people that you're working with in Iowa? And it's like, yep, this is the same guy. So yeah, look, but this property we're going up against today is a little bit less big of a project, a lot less problems. So I'm pretty confident with this one.
Yeah,
And
me too. So I want to introduce you to Brad Neal. Obviously, he's not on the call now, but he's my property manager in the Des Moines area. He has done an exceptional job. He manages everything that I have in the Des Moines area. He's probably has the top name in the entire market for property managers. He was actually an attorney, a litigation attorney for 10 years before deciding to get into the property management business. He built it from the ground up. So he has the Renter's Warehouse franchise in all of Iowa, built it from 0 units the day he started. And now he's up over I think he's closer to 750 units at the moment. Obviously adding on another 52 here in a month. So pretty excited to have Brad on my team and continue working with him.
Right. And if when I first heard we were using renters warehouse, I was a little skeptic, and I think I told this to you, Chase, that
Yeah,
you're sure you want to use these guys, because I have not heard very good things about this company before, but as I understand, it's all who the individual operator. I mean, they're all franchises. They just
yeah,
go off of the national name. So, um,
exactly. Yeah, yeah. It doesn't have the greatest name in some of the markets. I know a lot of local franchises that do have a really good reputation, but there again, every McDonald's has a few franchises that are going to be horrible, but the majority of them are going to be pretty solid. It's the same way with a lot of franchises.
right. And Brad, he's the current property management on all your properties currently, right? So he can't be that bad.
Yeah, everything in Des Moines. Obviously, I have a bit of property a couple hours away that he's not into that market, but everything that's in Des Moines, he's got everything. So I've known him. I've worked with him now for a while, and completely trust him and his team.
All right. So a little bit of background. I know a lot of we got a few slides here for the new guys, kind of first coming into these type of private placements. So the first thing is like why we're doing multifamily housing and not single family. I mean all the advantages are right here. I'm not going to read them all, but there's a reason why we jumped from single family into multifamily for all these reasons. And the subject property that we're talking about today is Ankeny Pine Apartments. It's in 1713 Northwest Pine in Ankeny, Iowa. It's a 52 unit building, Class C plus, and the location is in a much better area, B plus class. The business plan here is just simply acquire at a discount, which we are. We'll rehab it, put about $5,200 into each unit. It's a pretty heavy rehabbing plan. Usually I'd say about $3,000, $4,000 is probably a medium level. So this is one step above that. And we're going to plan to increase the rents and decrease the expenses. And the exit strategy here is to hold a 4 to 7 year hold. And the compelling story, I think, for this one is, because we're purchasing from a mom and pop owner, a lot of the profits are kind of baked into the purchase of it. And of course, the upside in rents. A lot of the rents are under market at this point. For
Yeah,
those of you who don't know, the asset classes, we're talking in class A, B, and C. This property, as he says, is a C plus. So you kind of go in these different classes. Class A is known as sort of the luxury apartments or luxury places to live. These are the new places coming online. The B class are your sort of blue and white collar tenant mixes. Class C is your blue collar and Section 8 mix. So our business plan here is to improve this asset from a C plus to get into that B class. And we talked about the neighborhood classes. This property is probably in a B plus class area, so it's a safe, desirable location, pretty good crime, and low commute to businesses.
yep.
Chase, you want to kind of go over the executive summary that we have, the offer out, and we'll kind of go into some more details
Yeah.
after.
Yeah, I'll let you move through this as I talk. One of the interesting things about this property is sort of the criteria that I generally look for is getting into that C class property that I can move up into a B. And generally, the three main criteria that I look for are high vacancy, problems with the property itself, so bad condition, or uh, or I don't even remember what the first one was. The high vacancy, problems with tenants, having bad tenants in there that are not allowing to raise the rents, and then property conditions. This one actually has none of the three, but what the main value add is in the property has been owned by an older gentleman. He's ready to retire. He's ready to move out of state. This is the largest property that he owns. He's pretty much done at this point once he sells this property, and he's run the property very well. He really maintains the property well. He keeps it kept up. But one of the main things is he hasn't done any updates in the last 15, 16 years that he's owned it. So that's one of the main value adds of this property. It doesn't stick into my normal criteria, but it is that C-class property in the B plus A minus neighborhood. And we'll get into that in a little bit. But
Yeah. So basically, I think we call this just a management play here. Nothing
yes,
really wrong with it, just undervalued rents, and let's go and improve it while we're at it to capture that market rent level. So today, I mean, basically, this presentation is sort of the opening the gates for investors to start funding this investment. It's a very small raise of about $1.1 million. We're putting it out at minimums of $50,000. We'd like accredited investors only for this one, and suggested accredited minimums are $100,000. The investors will receive, we're projected to receive 80% equity with a projected average annual returns of 8 to 11% in cash flow paid quarterly, and the projected 16% annual return with a sale on a 7 to 10 year hold. So we'll kind of get into the numbers here, and I believe that we've very conservative in terms of our underwriting, and you'll see sort of the numbers with that. And another thing to highlight again, the 80% profit split, 80-20 between the general partners and limited partners here, which is a very favorable partner splits. I think you're out there, you're usually seeing 70-30 splits.
yep, 60-30. I've even seen a bit lately.
Yeah. So what is a syndication? For those of you guys who don't know, the analogy we like to use is an airplane. So in the cockpit of this airplane, you have several general partners, key principals. These are the guys who do everything. They find the deal, they find the lender, they manage the property manager, they do the rehab, they distribute all the money to investors. They basically do everything. And this picture actually is a pretty good picture here. There's two of them, and in this deal, there's two general partners, and you're talking to them right here. And the plane has a coach, and which is the limited partners come. You pay your minimum investment to come in to buy your share of the LLC, and you just sit back and you relax and you collect your checks. That's basically what a syndication is. And there's a lot of team members that go into this. I'm not going to go through them all, but I'll just flash them on the screen really quick. Number 10 here, the key principals. These are the investors that will sign on debt and help qualify the loan. And that in this syndication, it'll be Chase and myself for that. We will also be the number 11 here, the asset manager, who oversees all the components and manage the manager. And we'll be also playing investor relations to be the direct communication to you folks. And of course, this wouldn't be possible without you guys, the passive investors, the LPs in this. And you guys can probably go out and make a higher return on your own, but there's a reason why we're all here. A lot of us are operators. You've kind of worked on the E side and then the B side of the business on this cash flow quadrant. And by being a passive investor in this investment, you're moving over to that I quadrant here, the investor quadrant. So Chase, why don't you introduce us to your market here in Iowa where you live?
Yeah, so those of you who don't know, I was right in the middle of the country, right in the middle of the heartland, which gives us a lot of benefits. Inside Iowa, Des Moines is the main market that we're in, which is right in the center of Iowa itself, right on the confluence of Interstate 35, which runs north and south right through the middle of the country, from Minneapolis all the way to Houston, and Interstate 80, which goes all the way obviously from San Francisco up to New York City. So right in the middle of the Mississippi River and the Missouri River, which rivers may not make sense to a lot of you guys, but when you're in the heartland, in the middle of the farmland where transportation is huge, it makes a lot of difference being right here in the middle of everything. Ankeny itself is right on the northern edge of the Des Moines metro, and our property is towards the north end of Ankeny itself. And what's significant about that is Ankeny has been growing like crazy. It's actually the fastest growing submarket in all of Des Moines. Between that and just following that is West Des Moines. And we are toward the northern edge. The property itself is kind of interesting, is that when it was built in '76, it was actually built on the very northern edge of town. In the last 15 years, Ankeny has doubled in population. and the majority of that population has gone north. So our property is no longer on the northern edge of Ankeny, and as it spreads farther and farther north, heading up towards the Ames area where Iowa State University is, we're sort of right in the middle of the path of progress. Yep, purchasing for $3 million. The property itself has, like we said, has been run very mom and pop by the owner. He operates it himself. He's a quote unquote property manager. He's done a really good job. He's put his heart and soul into this property, kept it up. He's got great tenants. He knows a lot of the tenants very well. It's got a really good reputation in the community. And it's always full. He's running right now at about an average of 98% occupancy, which is fantastic. I got in touch with the guy. Like I said before, I'm a wholesaler. That's one of the areas of real estate that I'm in. And so I know marketing very well. When I jumped into the large multifamily side, obviously the first place you go is you go to your brokers. You go to the commercial guys that know where all the deals are. Obviously, across the country, real estate is extremely hot right now. It is in Des Moines as well. And everything that touches the market is going up too high. There's just very difficult to find properties that I can offer really good returns like this one by finding something on the market. So I was able to use what I know in wholesaling to direct mail. I got into a relationship with this guy early 2017 or late 2016. I've known him for a while. Like I said, he's wanting to get out of state. He's got a boathouse. He said, all I want to do is be on my boat. Me and my wife, we want to be on my boat every day. He can't do that if he's personally operating this property. So he's now in the position where he wants to sell. And since I've developed that relationship, we moved right into negotiation on the property itself.
What kind of a direct mailer did you use? Kind of like a yellow letter. Hey, my name is Jace.
Yeah, it's a slightly more.
Guess you don't remember. Yeah, I mean, you probably don't even remember.
Yeah, I mean, it's essentially what I know with yellow letters. I used a white letter. It was more professionally laid out, but essentially it's the same thing. We sent out a bunch. We got a very low response rate, but we got into negotiation on all of them that did call, and this is the best one out of the entire group. And like I said, we developed a good relationship with him, so it worked out in the end. So the layout of this property, as you can see in the picture, there's 5 buildings, three-story buildings, two-story buildings, 52 units total. Very easy, very solid, all brick structures. One of the I love brick personally. It's very aesthetic for me. And one of the great things with brick is that you can tell very easily where there's a lot of settling, where there's foundation issues, because it's easy to tell with the tuck pointing work that needs done. You can see the stair step inside the grout. This property, there is a few areas that need some addressing, but it's built like a tank. It's very solid. Even the property inspector was very impressed with how strong this is. And since it's built in '76, it's had plenty of time to do all the settling that it's going to do.
Yeah, and I think that's important. When you're looking at these 1970s and 1980 properties, there's certain types of building structures that you definitely don't want to stay away from, like the Tudor type of construction. Like you just can't do anything with that. Like it's just always going to look old.
Yeah.
I mean, some of the A class apartment, like some of those huge 300 unit apartments, it's still brick, and it pretty much looks like the same thing like this. So. Exactly. Good bones on this thing.
So obviously we've done a full inspection. I've walked through every one of the units twice. I've also walked through with the inspector and with my contractors. We walked through several of the other or several units as well. It's been very well stewarded. He takes really good care of the property. Obviously there are some issues. You can see one hole in the door that he hadn't had a chance to fix. And there's A lot of the main issue is that while he's taken really good care of it, he has not done any major updates with anything in the property. He's replaced floors when it's needed. There's still probably at least a quarter of the units that still have carpet in the kitchens and the bathrooms. For whatever reason, somebody thought that was a good idea at one point. Um, but you'll tell some of these pictures that the hardware is from the 70s, the lighting is from the 70s, a lot of the flooring is from the 70s. Um, the appliances, same way. He's replaced appliances with new ones as they go out, but they're still they built appliances really well, supposedly back in the 70s, because there's still a lot of them running. But that allows us the ability to go in, do a lot of these cosmetic updates. So we're not moving walls, we're not doing any major construction. We are taking a lot of the easier stuff, the stuff that we're going to have to replace with the normal maintenance anyway, and doing it up front, putting in good materials that are going to last a while. So I'll go through a little bit of what we're doing to the properties themselves. Obviously, all the carpet, we're going with nice hard surface LVT for the majority of units other than the bedrooms, but new carpets there. Obviously painting, putting some new, not 1970s color paints. The cabinets are all in really good shape, so we're going to refreshen them up, resurface, repaint, put in new countertops, new plumbing fixtures, new hardware, all new lighting, new cabinet pulls. We're going to put in new vanities, new toilets. So really freshen up units, make them look a lot like what the new construction properties are going to look like from the inside. Like we said here, the property is about 98% occupancy, really good bones. It's in a really good position to go from that C plus by making some updates. Like we said, we're going to be throwing about $5,200 per unit into them, doing a lot of the things that will give us the products and the finishes that are going to last for a while, and also have the ability to raise up the rents as much as possible without spending a fortune inside the units. Yeah, you can see some of those appliances. The countertops got those beautiful yellow countertops from the 70s.
How is that refrigerator still working? I mean, that's
I
like
don't know.
40, 30 years.
I wish I could get the new refrigerators that we buy to last that long, but
Yeah, they're designed to break
yep,
like that.
yep. Yeah, so old vanities. The tubs are in great shape. The tubs were actually replaced 20 years ago or so. They're all one piece, so they're in fantastic shape. We'll still replace the faucets, replace all the fixtures, um, but
That countertop there doesn't look too bad.
it's not horrible. No.
Yeah.
Yeah. So the common area is kind of the same way. He's put in all new carpets in the common areas, the stairways. So a lot of that will last for a little while. When we do replace, we'll put in a hard surface. It looks nicer. It's easier to clean up. Doesn't hold smells like carpet does. There are washer and dryer units in every one of the buildings. They're all coin operated, which allows for some monetization of the laundry itself. There are no units currently that have washers and dryers in them. That's a potential upgrade that we'll look at down the road, but we haven't done a lot of research on the benefit of whether or not we're going to put in washer dryer hookups in the units.
Yeah, it's kind of on that cusp of it. You know, we're trying to get this up to like a B plus level,
Yeah,
and in the B plus in this area, it's just not what the competition has. So why even spend the money to do it if you're not going to capitalize on the rent?
exactly. So Ankeny itself, so very interesting. Like I said earlier, Ankeny itself in the last 15 years has doubled in population. We're up to about 65, 70,000 at this point. Actually, in what was it? In the last, no, I won't even go there. I was going to talk specifics on the market itself, but Ankeny, it's also one of the highest affluent cities in all of Iowa, and we're something like 42% higher per capita or per household income. The median is 42% higher than what the entire state averages. And it's something like 18% higher than all of Des Moines. So much more affluent. The schools are tremendous. They just built a new high school a few years ago, which is just 4 or 5 blocks north of this property. They just built a new middle school, a new elementary, several blocks to the east. They are in plans right now to build a third high school because the area is growing so quickly. They built several new elementary schools. Just on the east side of the property is a giant sportsplex, which includes, I don't even know, like 10 softball fields, few soccer fields, an aquatic center. And it's crazy that the place is completely packed almost every day in the summer and then the weekends in the fall. We are about a mile and a half, 2 miles away from the John Deere Des Moines Works, which is an enormous employer for the area, a lot of good jobs, a lot of manufacturing, but a lot of the engineering facilities are in there as well. We're a couple, 3 miles away from the Des Moines Area Community College, which is the largest community college in all of Iowa. It's actually larger population-wise than two of our state universities. And then Iowa State University is just 20 miles north, 15, 20 minutes away, which is a major feeder for the Des Moines market. There you go. So, oh, I was a little bit off. It's 28% higher than the Des Moines area. Ankeny is definitely where the most people are moving. Anybody who's affluent is going to the Ankeny area if they can. As far as the whole area goes, we're only from this property probably 20 minutes to get to downtown. 25 minutes will get you almost anywhere in the entire metro. We've got a really good infrastructure. We've got the two interstates that run through town, plus the little 235, like a sub interstate. I don't even know what you call those. You probably know. You work those.
Arterial, I think.
There you go.
Major arterial.
And that goes right around right by downtown. Um, so, like I said, we've doubled the population in the last 15 years. We're set to grow an average of 4 to 5% in the next several years. Actually, their 2040 plan for the next 25 years is pretty incredible, where they expect Ankeny to be as it spreads north and redevelops into the interior part of the city. Um, and we've got a lot of the historic stuff as well. So it's not just all new construction, all new development. We've got a really good history. Schools have been tremendous. They've probably one of the highest in all of Iowa.
Right. I'll highlight that 4 to 5% rent growth, or the growth. I think we underwrite it to 3% rent growth. So shade under this, but we can get into the numbers a little later. Yeah.
The numbers. We're actually at 2% rent growth itself.
Okay.
Trying to be a little conservative on several points here.
So you guys can do your own market research yourself, but I picked out a few, headliners. Here in the Des Moines Register, Ankeny is the third fastest growing U.S. city in the United States. There it is, number 3 there. Go figure. I didn't make this stuff up. This is real. This is real news.
That's right.
Again, the 4 developments that'll keep Ankeny booming. So they're saying a lot of the farmland is to the north and east of the city.
Yeah.
And this is where a lot of the growth will be happening over the next 5 to 10 years. Also saying there's been a lot of development in the area, $200 million of development, and looking for another $12 million to be planned to be completed by the end of the year. And we didn't talk about it earlier, but Casey's General Store, which is kind of a big chain in the region, their headquarters is there, and they're looking to expand their facility there with a $35 million expansion, so that the offices employ nearly 900 people and could add 80 more office positions over the next 5 years.
Yeah.
And if you're interested more about the town, check out the website, the Ankeny Plan 2040, and see what they have. But definitely a lot of growth, and kind of a you would think this would be a boring town in the Midwest, but it's growing.
It is, and we're definitely not. I like to say that Iowa and Des Moines is not sexy. We're not New York. We're not San Francisco, but we're solid. We're very reliable. Obviously, live in Iowa. We have a very low cost of living compared to a lot of the country, um, which is really good because a lot of the businesses we're seeing a very steady, not a super high growth of businesses coming into town, but we have a pretty high standard of living, but we have a low cost of living. So the jobs that we do have are very unlikely to move because where are they going to find cheaper work other than Mexico? If you want jobs in the country. And a lot of our jobs, because we're right in the middle of the heartland, are very ag based. So insurance is huge because a lot of insurance, whether you want it to or not, is based off of agriculture. Food is obviously one of the most important parts of everybody's life. Um, and so major manufacturers like John Deere, obviously, there's a huge benefit to them being located and centralized in the middle of Iowa because like I said, we're in the middle of the heartland where a lot of this stuff is being used. And we also have a tremendous infrastructure to be able to get parts in and out, be able to get the food in and out. Um, and that's we've been seeing a nice steady growth over the last 20 years that I've been here working, and then I've been watching and looking back at the records that companies aren't flocking here like crazy, but there's a nice steady growth of companies coming in. They really like the workforce. We have the the Iowa work ethic. I'm from Iowa, so I don't know any different, but I've heard the Iowa and the Midwest work ethic is pretty incredible. So businesses like that as well.
All right, so let's go over the some of the numbers that we put together here, Chase. The biggest thing here that we're trying to shoot for is to underestimate a lot of this stuff so that we can exceed a lot of the projections, and kind of go over what comps you use, because you walked a lot of these other comparables. So I'll let you kind of take it away here.
I did, yeah. So Brad, the property manager, and I did a lot of research on finding out exactly where this property sits and where the potential is. You can see here, so this data came from CoStar. For those of you know, is just a huge data center for rents and prices and markets in general in relation to real estate. The blue line here is obviously this property where it's sat the last 5 years. The other three, as you can see on the bottom, I don't need to explain this too much, but there's a certain group of properties that we compared this property to that are in Ankeny, similar types of properties. And then you have the general Ankeny market and then the whole Des Moines market. And you can tell they're all pretty much in line with each other, a little bit of variance, but they're all in the same trajectory. And you can see the gap between where this property is and where the market is in general. And that gap is the biggest value add for this property. Like we said, the owner is very mom and pop. He's owned it for a long time. He's said to us that it's made more sense for him to have a long waiting list for his property than it is to get extra rents. Definitely not the way that I see it, not my business plan, but to each his own. And obviously, he's done well with the property. So it's our goal to provide the affordable housing for the working class. This isn't a luxury property, but it's not a low income property either. And it's a really good thing to do for this market. It makes economic sense and it makes social sense.
So yeah, this is the big timeline here. This we'll kind of go over the individual business plan as we go year by year. But yeah, why don't you kind of, a lot of Chase, you're going to be taking this over. You're a lot of the boots on the ground here.
Yeah, yeah. This is where I live. The construction and the management is where I've lived the last several years. So I'm excited to actually get the property in and really start working on it. Um, the loan that we have, pretty simple, really good terms, 5-year term, 25-year amortization, 4% interest, 80% loan to value. Nothing super aggressive. We're not going interest only. We're not going super high leveraged. We're not um, trying to get in over our heads. Standard, and it gets us through the renovation, gets us up our occupancy to stay up, and it gets us to a point where we can either sell or refinance down the road. Um, like I said, first year, we're going to keep the occupancy up, or we're going to start doing the renovations. We have the ability, without touching the units themselves, to be able to raise the rents a certain level. For $45 is about where we're going to be raising them without touching into the units. And we're going to play with that number a little bit to, one, we want the rents up, but we also want to start pushing some of the tenants out so that we can get in and do some of the renovations, because then we can open up the entire rent all the way up to about $85 is where we're going to be sitting per unit on the raise. Current rents, you can see, are about 75 to 85% per square foot. The market is saying about $1. Really, the market's saying about $1.05 for this property. We're estimating that the initial, it's going to be about 95 cents to $1 a square foot. One thing that the owner doesn't allow any pets. He has 2 dogs in the entire property, and that's because they're service dogs. So he was required to let them in. There's a lot of people, it's very popular to own dogs and to have them. We're able to monetize that. And that'll allow us to drive up some additional income.
Because all that carpet in there.
That's right. That's right. Especially in the kitchens. Doesn't make sense.
Doesn't make any sense.
But yeah, so we're going to have that. We're going to put in a little dog park. It's super easy to put in, and that'll sort of help boost the attractiveness for the people that like dogs. I like dogs. I personally like dogs, and I like dogs in my places because I can charge them rent. One of the major thing that we're going to be doing to cut the expenses is, currently the property is perfectly set up for water sub-metering. There's a direct line going into every one of the units, and we're able to sub-meter, bill back the water usage, and be able to really reduce the overall utility expense.
And so I had a question here from somebody sent in about the actual renovation plan.
Yeah.
So you're talking about playing around with the bump it up $50 and just see what happens. Ideally, how many units would you like to start rehabbing right off the bat? Because we can kind of play around with that number to engineer. We could quite honestly get everybody out in a month, right? Just jack the rents up, but we wouldn't want that, right? Like, what's
No, and a couple reasons for that. One, we don't want to have a ton of vacancy. Obviously, we're not making any income if there's nobody in the property. We have the contractors that I've worked with before that are ready to move. It would be a lot more work, and they wouldn't be quite as efficient. I wouldn't be able to oversee it quite as well if we did everything all at once. And two, the tenants that are in there right now are good tenants. They're not tenants that are going to keep us from being able to get the rent as high as that what we're looking for. So there's really no reason to push really fast. I think it would hurt us overall in the long run to push too hard. So we're probably the first couple months, we're probably going to hit 5 or 6. That's going to be our biggest push. And then we're hoping just to stay steady of about 2 units per month after that. That's a really good timing for our contractors. It allows us to oversee, make sure everything is done as really well. We're getting good tenants back in. We're not rushing to just get anybody to fill the units. We're not having to spend a bunch on concessions to be able to fill the units and get them online again. So that 2 a month, we're going to do a bigger push in the beginning, just doing several properties the first couple months, and then 2 units per month. And that's where we're going to really play with that first rent bump. We'll probably start about that $40 to $45 mark. If we see that it's pushing too many people out, we'll drop it just a little bit, not much. But if it doesn't look like we're pushing enough people out, we'll raise it up to $50, $60 to really start pushing some of those tenants out.
Right. And I think a lot of the other Class C properties that I've done is, you want the people to leave, right? Because you have a lot of tenant problems, so you kind of, in this case, you'd bump it up $50, $60 purposely to get those people out. But that's just not the case here. I mean, there's a lot of good people that probably stay. They'll be willing to spend $50, $100 more a month just to stay in and take advantage of the new upgrades.
Yeah. And it's also our plan to offer the newly renovated properties to our current tenants too, and that's good for a couple of reasons. One, it really helps with the tenant rapport. People feel like they're being taken care of, that they're really looked after if they get the first choice, and it also opens up another unit for us to be able to start right into. So there's one more thing to kind of help the overall project, the overall reputation of our property.
Yeah. So we've got the current rents up there now, Chase. Do you want to talk about that now or a little later?
Yeah. So with Brad and I, we sat down and we went through the renovation itself. We wanted to pick out the right materials to really bump up the rent as much as possible, but also put in products that are going to last a while, that we're not going to have to go in and replace constantly. Um, and so he's also projecting certain numbers that he's very confident that he can perform at. And I'm pretty confident that he can perform at those too. We're running a little bit lower. So the rents themselves, we're running at about 3% lower than what he's projecting. And then also, he's pretty confident that he can hit that 5 to 6% vacancy number. And I don't doubt it. That's very common within the Ankeny market and the Des Moines market in general. So I don't doubt that he's going to do that. In all of our projections, we're running 10%. So 4 to 5% expenses plus or additional vacancy plus 3% lower rents. And those two numbers in general, if we can hit where the property manager's confident that he can hit, the projections are going to be quite a bit higher than that 80%. They're going to be pushing past the 100% in that 5-year mark, as opposed to where we're at. We just want to put a little bit of contingency on. We want to put a little bit of buffer. Like I said, we want to have a lot of happy surprises and not a lot of sad surprises. We want to overperform where we're promising everything.
All right. And Charlie Munger, Warren Buffett's buddy, said the secret to life is low expectations. So
That's right.
that's what we're doing here. So we head off into year 2. What's happening?
Year 2, very consistent. So we're going to keep up the occupancy. We're going to keep moving at the renovation pace. It should take us right at towards the end of year 2 to get all the properties renovated, filled, rents all raised up. And then we would really just focus on the additional operational improvements, making those little changes that really make the biggest difference, getting everything ready, keep it stabilized, get it ready for the possible refinance or the sell towards year 4, year 5. Like I said, we're bringing in Renters Warehouse. I personally know management pretty well. I've done it on a lot of property. I only recently brought on property management myself, but it doesn't make sense to manage it myself when I have such a great person inside the market. In Renters Warehouse, they have a fantastic reputation. They know the product, they know the market, they know how to get people in, the right people, and push it forward. So really excited to bring them on the team and be able to utilize them as a huge resource and as a huge team member to push this project forward. Then year 5 to 6, obviously we have the ability to sell. We have a much higher performing asset at that time, or we refinance, get everybody their capital back. Everybody stays in the deal. It kind of depends on the market, obviously. Those are the 2 easiest exit strategies. A lot of different possibilities with this property. And I want you to talk about the windfall on how that we need?
Yeah, yeah. So when you analyze these properties, it's there's a lot of multiple situations that can happen, and typically when we underwrite the properties, it's usually on a 5-year window for a sale or refinance. But as you start to refinance in year 3 or 4, year 5, or multiple strategies, you can kind of take that analyzer and throw it out the window because some of the numbers you get are pretty astronomical or pretty big a windfall that a lot of you investors would think we're pretty crazy for some of the numbers that would come out of there. But it definitely is pretty nice if things can happen that we're not counting on. But that's what a windfall is, right? If we can
Exactly.
refinance, if we can get all the renovations done pretty quickly, refinance at year 3, and then at that point it's infinite gains for all of us. And I think the difference between this property and a lot of other properties that they do the business plan, they sell it in 5 years, move out to the other thing. Chase is local, and I talking with Chase a lot. I think in the back of your head, you want to kind of make this a legacy project and keep cash flowing this. It's
I
part of your
do.
retirement plan.
Yeah, yeah. Me personally, and I think it's a great idea for the investors too. I'm very much a buy and hold guy. I've sold very, very few of the properties that I've ever bought and put tenants into. I flipped some property, and I don't like the tax side of selling property. So, um, and we haven't even talked about the tax side of the long term, even the short term of this property. Obviously, there's a lot of depreciation, especially when you get into the renovations that we're doing initially. All of our investors share in that depreciation benefit long term. You can probably speak more onto that, but
Yeah. Did you
there's
talk to the Provision guys about the cost segregation on this one? They're
we
going to come in and
we talked that we're going to do it. I think it's a great um, idea. There's a huge benefit to be able to do that. We haven't gotten into detail on what that's going to look like yet, but obviously we'll have to buy the property before we do the full analysis of the property.
right. So we kind of talked about the rents here. I'll let you kind of talk about the
Yeah,
comparables. But this is really where, in terms of analyzing properties, this is where this is the make or break right here, how well you can predict how you fall within the comparables.
yeah, it is. And there's two main aspects to this. So this is the group of properties, all within Ankeny, all fairly similar type of property. The highlighted bar is obviously this property itself, and you can see that the rents generally for all the one bedrooms are a bit lower than what the rest of the market's at. Another marker is to look over on the right hand side where it has the price per square foot. A lot of this is sitting um, towards the 80, 90% or 80 to 90 cents per square foot. A lot of the other properties are pushing past $1. And you'll see that as we get into the two bedrooms as well, is that same way. There's one property that has lower rent, but you can even see down below that that our property is much lower rent per square foot. So even bumping up to the 95 cents going towards $1, that's going to increase the performance quite a bit and actually just getting us to market. We're not projecting that we're going to blow away the market, that we're going to be able to rent for $1.25 a square foot. That's just not the case. It's not a super high class A property, but we want to get in line with the other properties. Here's the breakdown of the one bedrooms and two bedrooms specifically. You can see very similar to that other graph. We are well below market for the rent currently. A lot of room to grow without a lot of work.
So in our analyzer, what did you finally use for the last projection, Chase? For what do we get the rents up to?
Yeah, so the one bedrooms we're going to be renting at, I believe, is 98 cents a square foot for both, and that pushes up to 735 on the one bedrooms and 830 on the two bedrooms. There again, Brad is projecting on the one bedrooms to be about 755 on the one bedrooms and 860 on the two bedrooms. So we have about a 3% gap in there. that'll bring us up closer to where these other lines are. And a lot of this benefit isn't because, like we said, the property's in horrible shape, or it's in a horrible neighborhood, or has horrible tenants. It's just that the current owner much prefers a long waiting list and to have zero vacancy, as opposed to really getting his money out of the property. Here's the real breakdown. Here's the nuts and bolts on everything. We can go far into detail on this, and I would love to be able to do that. But we'll kind of go in the overview. So overall, year one, after everything is said and done, renovations are done, rents are up. We're at a total of $482,000 for the gross rent. We're pulling back on that number. So the first year, we're at close to an 18% economic vacancy. That pulls out the time that we're going to be down for construction, pulls out all the low rents that are there in day one before we're able to start implementing the raises. And then we have the laundry. Currently, he doesn't rent out there's storage units, so big closets that are in each one of the buildings. He has them locked up and empty. We're going to open them up, even if we charge $25 a unit, which is really low for storage, climate controlled essentially, because they're indoors. I think we can significantly increase the whole performance of this property. There again, we're going to bring in the pets, be able to monetize those, since there's a huge demand for people with dogs, with cats to come in. I won't go too much into the detail, but hitting close to that 40 to 45% of expenses, which is normal for this type of property. A little bit lower because we don't have any on-site maintenance, any on-site management. It's not a big enough property. It doesn't need that sort of attention. We have the full management fee, so it works out really well. So first year, like we said, because we're doing the renovations, because the rents aren't up day one, the first year returns about 5.5%, 6%. Then we build up to 10 and 11% once we get out everything stabilized, the rents up, keep everything filled. And there again, those two biggest numbers, there's several points in here that I think we can outperform, but the two biggest ones are the gross rent and the vacancy, that we're very confident that we can significantly outperform what these projections show.
Right. Yeah. And there's a difference between Iowa and Dallas, of course, but I think we've adequately projected the numbers to account for that. And like I said, it's the vacancy. As this thing stabilizes out, we're sitting at 10% vacancy. And it's, on this property of 52 units, I doubt that there's going to be 5 units vacant once this thing is stabilized. Right. And then the average rents there, the increases per year, I think we've adequately conservatively underwritten that to account for that. It's just, Iowa's just not a blazing hot market, right? You're not going to have the, there's a lot of people in Dallas that are doing deals that are just kind of sloppy about it, and they're just getting bailed out by the market.
Yeah.
I'll say that.
Good. It's always up, but it's not your super high growth. We're never going to see a 10% growth in anything, expenses or rents. But it's a nice steady growth. We have a nice steady growth of jobs, nice steady growth of population. So we're moving in one direction, but it's steady, it's consistent, it's reliable.
Right. And I've got this list of sneaky tricks that syndicators like to do to cook these books right here. And one of them is putting the annual rent growth to like 4%. That's kind of absurd, I think. We've got it here at 2%. So
yeah,
got you guys covered with that.
Yeah. Rent and expenses, we have it at 2% increase every year. So this is interesting. We put this in there. We're buying obviously at a discount, but we think the market, if it stays consistent, we're going to be at that 7 to 7.25 cap rate when we go to sell. You can see here that we're projecting at the 7.25. We're not super aggressive. We're not saying that the market's going to continue to increase. We're not hoping that the market's going to bail us out, like you said. So this just kind of gives us a little bit of varying that if we do sell out at that 7.25, we're going to be at the 80%. If we do, the market significantly increases, then we're going to be pushing 100% based on those same numbers. If we're way off on our numbers and we're half a point off, we're going to be at a 62%. So even if we're way off, we still have some pretty good overall returns. There again, I was pretty consistent. We're not moving up or down very fast. This is another. I love these stress tests. I love the split testing. This is another one that we've used that shows where our market is going to be at, or where the returns are going to be at, depending on market conditions, the things that we can't necessarily control. There again, you bump up the vacancy, and the numbers go down. You bump up or down the projected revenue, and you can kind of see where all the returns sit at here. There again, if you go through where the market, or where Brad and where the market averages just on the vacancy itself, we're going from the 8.22 stabilized, first year stabilized, down to like almost a 10% point at there. So we're just that vacancy number by itself, improving that number from what we're projecting will give us a 2-point increase in a single year of cash flow.
Right. And I think if there's anything that we can beat, I think there are probably about 3 or 4 big categories that we can beat. I think this is the one. So taking it from that 10%, which is putting, if you're looking in that blue section, 8.22, if we can drop it down to 7 or 6, now we're sitting almost to 10% cash flows. So I think that's the ace up the sleeve on this deal.
Yes. Here shows the returns year one. Like I said, 5.5%, 6%. Then we're bumping up, past 10 on year 5. That gives us overall with the sell there at the 7.25 cap rate. We sell out. That's 37% return just by itself. So that bumps us up to a total return based on that 5-year sell of 80%, 16% annualized, which is pretty good for a very steady, controlled product like this.
Yeah, so it's kind of wrapping things up. The minimum investment that we're looking for from accredited investors is $100,000. We'll talk to some of you first timers at a $50,000 minimum, because one of the things that me and Chase like to do is like get the regular people involved in these kinds of private placements. But do the math at $100,000. I mean, we only need like 9 of you guys, so this thing is going to fill up pretty quickly. I don't think you'll find any other deal with this sort of a product, with this, with a good operator like Chase, with an 80-20 split. Good luck. Let me know when you find one, as I say.
Okay.
So first come, first serve, and we reserve the investment spots to the most qualified and highest investor amounts. So if you're just coming in and saying, hey, I just have 50 or 75, you may not get in this one. And when you guys, we're looking for these two answers to these 2 questions. What is your potential level of investment, and you plan to use cash, self-directed IRA, or solo 401k funds? We will accept those, but they just take a little longer, so we'd like to know. Yeah. And just to kind of conclude things, I'll let you put in your final words too, Chase, but total return is sold in 5 years is conservatively projected at 80%. And I am pretty sure we can beat that. If we can improve the vacancy on that 10%, we can bump the rents up higher. And, maybe we might get lucky with some appreciation, and that might get even better. But I think we've adequately protected the downside on this deal.
Right.
Me and Chase have skin in the game, and a lot of relationships are at stake with you guys, our investors. And, we're going to take the utmost fiduciary and be transparent in the future, because it's just me and Chase on this one, and it's just you guys. So you guys are going to have that direct line of communication We're fully committed to the success of this project as key principals signing on the debt on this one. Chase has definitely opened up his pocket and put down 170 grand hard into this money. And here's the timeline that we're looking at. This week, investor PPMs are ready to go out for review. Mauricio should be finishing that up, and we'll send that out. But we're not going to be sending out to anybody. Just if you need to shoot us back and express interest, and we'll send it out to you. We don't want the PPMs to be floating around. To February 12th, we'd like the PPMs to be signed at that time, and then all funds to be wired in before Valentine's Day. So if a lot of you guys need to talk to the boss, good timing here. Knock two birds with one stone.
Wrap the PPM in a nice bow. Let her know you got something real good for her.
And we expect to close in early April. Is it? No, that's the typo. End of February, right? Right.
Yep. So definitely moving forward. We've had a good amount of commitments already. So yeah, definitely don't wait. We are really excited about this project, ready to get it working. We've got a fairly quick timeline here, so excited to get started.
Yeah, so our contacts are there at the bottom, and I guess Chase, I've got some follow-up questions here from some folks.
Yeah.
First question here is, how close is this to Starbucks, and what else is near this area?
Oh, good question. So straight east of the property, like I said, the whole market sits right on Interstate 80 going north or 35 going north and south, and straight east is right off the highway. Probably, like I said, 2 miles from the highway itself, the interstate. There's a couple Starbucks right there. We've got a lot of the major retailers just south of the property a bit, and then there again on the east side of the town. So really close to Starbucks. I know it's a big factor for a lot of people.
What are you buying? What kind of cap rates are you buying this at?
Yeah, so this property we're buying, we're getting a really good deal, I think, overall. Buying at about 7.5 cap. I think market is anywhere from 7 to 7.25. So we're getting a pretty good deal on this. Obviously, I'd like to say that I'm an expert negotiator. I don't know that that's the case, but we did build up a pretty good relationship with the seller, so it's gone over pretty well.
And percent and increase in rent. What do we have?
We have a total of about 10% that we're going to be increasing rent. Like I said, we're sitting at about an $84 increase, and the rents are going up to about the 730 to 860 range. So,
all right, and that's kind of one of the biggest things. You guys underwriting properties at home, your own multifamilies. I would say anything above 10%, you better be in a super hot market like Dallas or Austin.
right.
I see so many deals out there where they're projecting like 15, 25%, and I don't know what they're smoking there. They probably have legalized marijuana, but like you're just not going to have that and be able to like have decent vacancy to cash flow those first couple of years.
Exactly.
So I just want to stress that 10%, that's very conservative.
Yeah, it is. There's definitely room to go up to that 15% number, but there again, we want to be conservative and we don't want the vacancy either. Vacancy doesn't help performance at all.
Right. That makes you stressed out, right? When you're not getting that cash flow as the operator. How will investors get paid, Chase? Who gets paid first?
Yeah, good question. So like you said, we have an 80-20 split. So out of all the profits, out of all the expenses and the debt service comes out, then the investors get 80% of that. Like I said, first year, we're a little bit lower. We'll be completely open doors, be honest. The returns for first year aren't fantastic, 5.5%. I think we're at like 5.61 projected the first year. So not tremendous, but we bump up once the vacancy is up, the rents are up, and we're moving forward stabilization. We pay out quarterly. So all the returns, we have a pretty good working capital amount inside the raise. So we don't need to hold on to a lot of extra capital as we get the cash flow in. So all of the profit that comes in, we're still very conservative. We are able to completely distribute all of it as we go.
And Chase, talk about the debt that we're getting on here. We're not going through Fannie Mae, Freddie Mac. We're going through a community bank that you've got to build up a relationship with those guys there locally,
Yeah,
right?
yeah. So it's a bank here in town. It's a branch of U.S. Bank. So they're what I think the third or fifth largest bank in the entire country, but they've got a very solid local presence here in town, and it's with a lender that I've known for a while. I have a really good relationship with. Um, it's not agency; it is full recourse. So Lane and I, we're signing on it. We're guaranteeing it. We're obviously very uh, confident in the deal. We won't sign on a loan that we are not confident on. So we got good terms. It's essentially a bridge because we're working towards either that sale or that refinance, and we'll probably move into agency debt at that point, either Fannie, Freddie, or FHA to go for a long-term debt.
And I think we kind of went over the amenities, like take out the carpet. But what about the appliances? We're going to play around with appliance packages and maybe bump the rents up even more.
Yeah, yeah. So we're going with a fairly solid. There again, Iowa Midwest. We're not fancy. We're not going stainless. We're not going black. They'll be white. They'll be basic, but they'll be nice. New. Obviously, you can tell with that stove and those refrigerators that are 30, 40 years old. Um, they're nice. They're relics. They're antiques. Maybe they're going to come back, but we're going to replace them all. He has replaced several, so we're not replacing every single unit, but for the most part, we're going to completely freshen it up, get some new stuff in there, um, and yeah, we've got some really good products that are going to be going in.
So maybe talk a little bit more about that. It's like the owner currently hasn't really done much, but has he sort of haphazardly upgraded some of the units that at least we have a test here, or is it pretty much a clean slate that we have to?
It's a very clean slate, other than flooring, because obviously he's needed to replace some of the units. There's definitely not a lot of units that have really horrible stained, crappy flooring, but that's the majority of what he's done. He's replaced appliances that have gone out, but it's been sort of all over the place on the quality and the type of appliances going in. I don't think he's replaced a single vanity. They're still in decent condition, but they smell of the 80s and the 70s. So getting some new product in there, especially there in the kitchens and the bathrooms. That's where we're going to be focusing a lot because that's where you can tell that a lot of those finishes are from the 70s. Replacing a lot of that stuff's easy. It's fairly, relatively cheap, but it makes a huge difference to the tenants and able to really be able to bump up the rents with those.
All right, I think that's the last question there. You got any closing comments, Chase?
I don't think so. I'm excited to meet everybody and move this project forward. I'm excited to get it started.
All right. So if you guys are interested, please shoot Chase or myself an email. Our contact information is on the bottom. And thanks for joining us.
Thanks
Thanks,
a lot.
Chase. Talk to you later, man.
See ya.